welcome to Griffonomics. I want you to imagine, for just a second, the absolute biggest bottleneck in the artificial intelligence revolution right now. Like, what comes to your mind?
Most people are probably thinking about the advanced semiconductors, right?
Right, exactly. Chips, or, having enough high-quality training data to actually feed the models.
Yeah.
But the ultimate bottleneck, the physical wall, that could honestly bring this entire technological leap to a grinding halt, it's electricity.
Yeah, it always comes back to power.
It really does.
Yeah.
So today, our mission for this deep dive is to unpack a company that is attempting to pull off, well, one of the hardest maneuvers in modern business. We're looking at Eaton Corporation, ticker symbol ETN.
Which is fascinating because they are a 100-year-old legacy industrial manufacturer.
Exactly. And they're trying to completely change their identity to become the foundational backbone of the AI supercycle. Some people on Wall Street are actually calling them the NVIDIA of power right now.
That's a huge title to live up to.
It is. But to earn that title, they are taking on literally billions of dollars in debt. And they're facing massive real-world execution risks. So we really need to dig into this.
Yeah, and to understand the sheer scale of what they're attempting, you really have to look at their reality in the first quarter of 2026, because they are operating at an incredibly high level right now.
The numbers are pretty staggering.
They really are. They posted record revenues of $7.45 billion for the quarter.
Oh.
Yeah, that's up 17% year over year. And, what's crucial there is that 10% of that is what we call organic growth.
Meaning it's coming from their core business, right?
Exactly. Underlying demand for what they already do, not just, revenue they bought by acquiring other companies. Yeah. But as impressive as those top-line numbers are, the real story here is the friction.
The friction between the demand and their strategy.
Right. It's the friction between the surging demand and the massive strategic shift happening beneath the surface. They are fundamentally restructuring what they do and who they serve.
Let's get into the mechanics of that restructuring, because they're changing their entire operating environment. Historically, Eaton has operated in what the industry calls the gray space.
Right, the traditional utility stuff.
Yeah, gray space is traditional utility grid power distribution. The heavy industrial equipment. We're talking transformers and switchgear that get electricity from the main power plant to, like, the outside walls of a building.
But that's not where the high margins are anymore.
No, it's not. So their new strategy is this highly aggressive push into the white space.
Yeah.
Meaning they're moving inside the building, directly onto the data center floors, and right into the IT server racks themselves.
And that transition is absolutely critical because, in the gray space, you're dealing with utilities and general contractors.
Right.
But in the white space, you are dealing directly with the hyperscalers, the Amazons, the Googles, the Microsofts of the world. You're providing the thermal management and power distribution right down to the microscopic chip level.
I want to use an analogy here to map this out for you, because it's a huge shift. This feels like a major delivery company changing its entire service model.
Oh, I like that. How so?
Well, historically, they were the logistics guys who just, dropped your heavy packages off at the curb. That's the gray space.
Yeah.
Getting the power to the edge of the property. But now, they have completely rewritten their contract with you.
Right, they're coming inside.
Exactly. Now, they're walking into your house, opening your refrigerator, and actively unpacking the groceries right onto the shelves for you. They are right there in the server rack. But, I have to push back hard on this premise.
Okay, what's the hang-up?
Eaton is a legacy industrial gear manufacturer. You don't just wake up one morning, dust off your 100-year-old brand, and suddenly become this agile, integrated tech partner for the most demanding software companies on the planet.
Right, the cultures don't naturally mix.
They don't. So how are they actually convincing Microsoft and Google to let them, inside the fridge?
Well, it requires a ruthless dismantling of their old corporate structure. They couldn't do it the old way. So on April 1st, 2026, Eaton officially launched a dedicated global data center segment.
And that wasn't just a rebrand.
No, not at all. This wasn't just slapping a new logo on an old division. It was a complete structural realignment. See, previously, if a hyperscaler wanted to build a data center, they had to buy gray space electrical gear from one Eaton division.
Okay.
And then they have to go and negotiate with an entirely different Eaton division for the white space server components.
That sounds horribly inefficient.
It was incredibly inefficient. So now they've centralized it. They serve as a cohesive, single-point partner. Amazon or Google makes one call to one dedicated team that handles the entire power journey, from the utility substation all the way down to the motherboard.
But they're also actively shedding parts of their identity to make this work, right?
Yeah.
Like, they announced that by the first quarter of 2027, they're going to spin off their legacy mobility business.
Yes, the vehicle and e-mobility segments.
Yeah, into an entirely independent, publicly traded company. And I have another major point of skepticism here.
Let's hear it.
Spinning off the traditional gas-powered vehicle segment, okay, that makes sense. But why spin off e-mobility? Electric vehicles are supposed to be a massive part of the green energy wave. Aren't they, uh, aren't they leaving future money on the table by cutting the cord on automotive right now?
It definitely looks counterintuitive on the surface, but honestly, it comes down to margin stability and identity.
Identity for Wall Street.
Exactly. The automotive sector, even the EV side of it, is notoriously cyclical. It's tied to consumer spending, it's tied to interest rates, and, massive supply chain volatility.
Right. People stop buying cars when rates go up.
Exactly. And historically, that segment has had lower profit margins. So it drags down Eaton's overall profitability profile. By shedding that cyclical automotive drag, Eaton is actively purifying its identity for the market.
They want to be a pure play.
Yes, a pure play infrastructure enabler. They want investors to view them strictly as a high-margin electrical and aerospace company. Because if you keep the EV business, your stock price gets punished every time car sales slow down.
Even if the data center business is absolutely booming.
Exactly.
So they're dropping the baggage to focus entirely on this new environment. But, I mean, if you are moving into this white space directly inside the server racks, you need the technology to actually survive in there.
Because it's a brutal environment.
Yeah, the demands of an AI server rack are entirely different from traditional IT. It's an extreme physical environment. And that is the driving force behind the absolute biggest strategic move they have made so far.
Right, the Boyd Thermal deal, it is the absolute linchpin of their whole gridded chip strategy.
So break that down for us.
Well, they finalized the acquisition of Boyd Thermal in March of 2026. And the price tag was $9.55 billion.
Wow. Almost $10 billion. That is an astronomical bet on thermal management.
It is a massive capital outlay. But when you look at the physical reality of next-generation AI hardware, it was an absolutely necessary bet. The entire industry has hit a thermal wall.
This is the air versus liquid debate.
Exactly. Modern high-density AI chips, specifically things like the NVIDIA Vera Rubin architecture, they are incredibly powerful. They process billions of calculations a second. But the byproduct of that computing density is heat.
Extreme heat.
Extreme heat. We have literally reached a physical limit in thermodynamics where simply blowing cold ambient air across these servers is completely obsolete.
The air just can't carry it away fast enough.
Right. The air simply cannot carry the heat away fast enough to keep these chips from literally cooking themselves and melting the silicon. You have to use liquid cooling.
And Eaton didn't just buy, a minor participant in the liquid cooling market. Boyd Thermal is the heavyweight.
They really are.
They command a market share of over 40% in-server cold plate technology.
Right, which is huge.
Yeah, these are the highly specialized engineered cooling plates that sit directly on top of the silicon chips. They use a closed loop of liquid to draw the extreme heat away from the processor. By acquiring Boyd, Eaton essentially bought the dominant market position in the exact technology that makes the next generation of artificial intelligence physically possible.
Which fundamentally changes Eaton's relationship with the hyperscalers. Like we said earlier, they aren't just selling commoditized power cables or backup generators anymore. They are co-creating the infrastructure directly with the AI leaders.
Think about the trust factor involved there. If you're Amazon or Google, you have a single server rack filled with, millions of dollars of advanced AI chips.
Easily.
You are not going to trust the life support system of those assets to a low-bid vendor. If the cooling fails, your multi-million-dollar asset just melts. You want a partner who deeply understands both the raw power flowing into the building and the thermal heat being extracted from the chip. Eaton is positioning itself as the ultimate protector of those massive investments.
And Eaton's CEO, Paulo Sternadt, he's explicitly described this as a game of trust. You are touching the most expensive, mission-critical assets these tech giants own. If Eaton's cold plates leak, or if they fail to draw the heat away properly, the entire data center goes down.
Okay, so you've stopped the AI chips from melting, you have the heat extraction handled, but you still have a massive physics problem. How do you actually deliver the astronomical amounts of electricity these liquid-cooled chips demand without wasting a ton of power before it even reaches the server?
This is a fundamental inefficiency in how traditional data centers are powered. And Eaton is driving a major technological shift to solve it.
The 800-volt DC shift.
Exactly. In a legacy data center, you lose a massive amount of power through multiple conversion stages. The utility grid delivers alternating current, or AC power, but the actual computer servers operate on direct current, or DC power.
So you have to convert it.
Right. So in a standard setup, the power comes into the building as AC. It gets converted to DC, then it gets stepped down in voltage. Sometimes it gets converted back to AC to feed into backup battery systems, and then it has to be converted back to DC again before it hits the server motherboard.
That's a lot of jumping back and forth.
It is. And every single time you convert that power from AC to DC or vice versa, you lose energy. And that lost energy doesn't just disappear, it turns into heat.
I mean, it's exactly like exchanging currency at the airport, right?
That's a great way to think about it.
Yeah, every time you swap your dollars for euros and then swap those euros back to dollars a few days later, the exchange desk takes a cut. If you bounce your money back and forth 4 times, you've lost a huge percentage of your original cash just in transaction fees.
Exactly.
In a data center, those transaction fees are lost electricity. But it's actually a double penalty because that lost electricity turns into ambient heat, which then requires you to use even more electricity to power the air conditioning units to cool that heat down. It is a vicious, highly expensive cycle.
So to eliminate those transaction fees, Eaton is pioneering an 800-volt direct current power distribution architecture. Instead of running AC power through the building and converting it at the last possible second, they're taking the power, converting it once, and moving it directly through the facility to the racks at 800 volts of direct current.
So you just eliminate those wasteful intermediate conversion stages entirely.
Entirely.
There's a metric in the source material that perfectly captures why this matters. CEO Paulo Sternadt is hyper-focused on a concept he calls tokens per megawatt.
Right, tokens.
Yeah, token is the basic unit of data that an AI model processes. So the ultimate goal of these hyperscale facilities is not just to consume power, it's to generate the maximum number of AI tokens physically possible for every single megawatt of electricity they pull from the grid.
And the 800-volt DC shift is the primary mechanism for maximizing those tokens. By eliminating the heat generated from all those AC to DC conversions, you drastically reduce the facility's reliance on traditional HVAC chillers.
Which use a ton of power.
A massive amount. Historically, just keeping the ambient air cold eats up about 20% of a data center's total power budget. By moving to 800-volt DC and combining that with Boyd's liquid cold plates on the chips themselves, Eaton is pushing the overall facility energy efficiency from a standard 93% up to an astonishing 98%.
You know, going from 93 to 98% efficiency might sound like a rounding error to the average person. But when you are talking about a gigawatt-scale AI data center facility, a 5% difference in power efficiency is worth tens of millions of dollars a year in operational savings.
Over the lifespan of a facility, it's game-changing.
It completely changes the financial modeling of the facility. So we see the complete vision here. They have the strategy bridging the gray space to the white space. They have the technology, liquid cooling, and 800-volt DC architecture. But is the broader market actually buying this integrated vision?
Oh, the demand metrics are absolutely staggering. The sources show that the total U.S. data center pipeline has ballooned to 228 gigawatts of capacity.
Let's slow down and put that number into perspective, because 228 gigawatts is almost incomprehensible.
It's a massive number.
Yeah, a standard nuclear power reactor produces roughly 1 gigawatt of electricity. So the U.S. pipeline is essentially demanding the equivalent power output of 228 nuclear reactors just to feed these data centers.
And translated to Eaton's business model, that 228 gigawatts represents 12 years of backlog at the current 2025 build rates.
12 years.
12 years. It is a runway of demand unlike anything the industrial sector has ever seen. The composition of that pipeline is also incredibly telling. Right now, there are 32 gigawatts of capacity actively under construction across the United States, and 70% of that construction is strictly dedicated to AI workloads.
A 12-year runway sounds great on a forward-looking press release. But, I mean, looking at their actual Q1 2026 financials, I am trying to figure out how that translates to tangible cash flow today. Were these just soft commitments, or is this real money hitting their books?
Oh, it is translating to explosive booked growth. In the first quarter of 2026, their electrical sector backlog surged by 48% year over year.
48% in one sector.
Yeah, and that single sector's momentum pushed the total company backlog to a record $22.8 billion. They have nearly $23 billion of hard, committed orders sitting on their books waiting to be built and fulfilled.
It's also vital to note that it's not strictly data centers driving this. Even though AI gets all the headlines, Eaton has multiple massive engines running in parallel.
Right, the broader infrastructure play.
Yeah, the broader mega project backlog, which includes giant utility upgrades and heavy industrial builds, is sitting at $3.3 trillion globally. And then you have their aerospace division, which is quietly crushing it in the background. They just posted a record $5.0 billion backlog in aerospace, up 28% year over year.
And the aerospace division is also highly profitable. They're operating at 26.7% margins there. They're actively expanding that footprint as well. In January of 2026, they closed a $1.53 billion acquisition of a company called Ultra PCS.
Okay, what do they do?
That deal added highly specialized electronic controlled and data processing capabilities to their aerospace portfolio. So if the data center market ever hits a speed bump, they have this massive, highly profitable aerospace engine to balance the portfolio out.
Everything we've discussed so far paints this as an absolute dream scenario. They have a 12-year backlog, they're dominating the AI cooling space with Boyd Thermal, and they have massive margins in aerospace. But we need to look at the shadows here.
The execution risks.
Exactly. Having a $22.8 billion backlog on a financial spreadsheet is one thing. Actually fulfilling those orders in the physical world, sourcing the materials, building the gear, shipping it, and installing it at scale, that is a logistical nightmare.
The execution risks are severe, and we have to address the financial anger they've tied around their own waist to pull this off. Eaton went on a massive $11 billion acquisition spree to build this grid-to-chip empire.
Right. Buying Boyd and the others.
Yeah, Boyd Thermal, Ultra PCS, and infrastructure companies like Firebond and Resilient. But that $11 billion was not free money. To fund this transformation, Eaton's long-term debt has literally doubled. They are now carrying a staggering $18.54 billion in debt.
Wait, $18.5 billion. That is a very heavy burden, especially in an economic environment where interest rates are not sitting at zero anymore. Debt service is a very real threat to cash flow.
It is, and you can see the immediate impact of that debt in their Q1 2026 financials. Their interest expense tripled year over year, hitting $106 million for just that single quarter.
Ouch.
Yeah, that is over $100 million in cash going straight out the door every 3 months just to service the debt they took on to build this strategy.
That debt burden makes a particular metric in their Q1 earnings really glaring. There's a massive paradox here. We talked about their record $7.45 billion in revenue and a 17% growth, but their gross margins actually compressed.
They did.
They shrank by almost 3%, dropping 280 basis points, falling from 38.4% down to 35.6%. How does a company with more demand than it knows what to do with, selling highly specialized AI gear, actually become less profitable on the products it sells?
Well, in a theoretical vacuum, record demand leads to higher margins. But this is the reality of scaling physical infrastructure at a breakneck pace. Management has been very clear about what drove that margin compression.
Okay, what's their explanation?
First, you have severe commodity and wage inflation. Copper, specialized steel, skilled electrical labor, all the core inputs required to build this technology are getting significantly more expensive. But the primary driver of that margin drop is the sheer upfront cost of capacity expansion.
Because you cannot build 228 gigawatts of advanced data center gear in your existing 100-year-old factories. You literally have to build new factories just to build the gear.
Exactly. Eaton is currently investing over $1 billion in capital expenditures just in the Americas region. They are in the process of ramping up 12 brand new manufacturing facilities.
12 new factories.
12. And they have 6 more scheduled to come online by the end of 2026, and another 6 major expansions planned for beyond 2027. Spinning up a new manufacturing facility is incredibly capital intensive.
I mean, you're pouring concrete, buying assembly robotics, and training thousands of new workers?
Exactly. And all of that upfront spending drags down your gross margins heavily until those new factories are fully operational and running at optimized capacity.
They're essentially in this awkward, highly expensive teenage growth spurt. They have the billion-dollar orders in hand, but their sleeves are rolled up and they are bleeding cash to actually build the physical footprint required to meet those orders.
And management is not hiding from this either.
No, they openly admit that supply chain bottlenecks and severe labor shortages are the primary execution risks to meeting this massive production ramp between 2026 and 2030. You can have all the copper in the world, but if you can't find specialized technicians to build 800-volt DC systems, the factory floor sits idle.
The market is watching their execution under a microscope right now. The backlog is totally secure. Nobody is worried about demand. The question is purely whether Eaton can navigate the physical realities of global supply chains, factory yields, and labor availability to deliver the product without bleeding out their profit margins in the process.
Which brings us to the ultimate question for you, the listener. As you look at this landscape, does Eaton's unique ability to bridge the heavy utility grid all the way down to the liquid-cooled server rack justify its premium valuation?
BNP Paribas certainly thinks so.
Yeah, they recently listed them as a top pick, issuing a bull case price target of $555 a share. Are they truly the NVIDIA of power?
The potential is absolutely there, but they are operating with a razor-thin margin for error. If Eaton can execute this flawlessly, if they can get these 24 new factories running smoothly, successfully integrate Boyd Thermal's liquid cooling without destroying its agility, and manage that $18.5 billion debt load, then yes, they have positioned themselves perfectly as the physical backbone of AI.
That is a lot of ifs.
It is. That debt and those current margin pressures leave zero room for mistakes. If AI demand softens even slightly, or if supply chain snags delay their new factory outputs by even a few quarters, that $18.5 billion debt anchor will become incredibly heavy.
It is a high-wire act with billions of dollars and the future of tech infrastructure on the line.
It really is. And taking a step back and connecting this to the bigger picture, this situation raises a profound question that goes far beyond just Eaton's stock price. Consider the nature of artificial intelligence itself.
Okay.
AI software can scale almost instantly. A company releases a new language model, and it can be deployed to millions of users around the globe overnight with the push of a button.
Just copy and paste code.
Exactly. But if Eaton, the company representing the absolute physical backbone of this technology, is facing a 12-year backlog that is severely bottlenecked by real-world limits on skilled labor, raw copper, and factory floor space, what does that mean for the timeline of the entire global AI revolution?
That's the real bottleneck.
It is. Software scales instantly, but copper, steel, and physical cooling pipes do not.
That is the ultimate reality check for this entire supercycle. The boundless digital world of AI is completely tethered to the physical world, and the physical world takes time to build. Risk defined, portfolio protected.